All right, everyone, good morning. Today is Saturday, November 7th, and let's run through a deep dive in the world of leverage finance and CLOs. To kick things off, let's talk about the rotation we've seen into high yield bond funds from leveraged loans. Leveraged loan funds saw about $274 million of outflows this week, which goes hand in hand with the week prior's $504 million in redemptions, and the week prior to that, $76 million of inflows. The net outflows from these funds are totaling about $20.7 billion, in contrast to the world of high yield bonds, which have seen inflows of about $31.4 billion. This week alone, we saw $2.2 billion of redemptions. And in the week prior, we saw 2.5 billion of outflows, and the one prior to that, about 150 million of inflows. So the contrast between 31 billion of inflows into high yield bond funds is highlighted against the world of leveraged loans with nearly 20.7 billion of outflows. All right, let's talk about the impact of the coronavirus pandemic on the world of credit. Considering both trends and sector, the table on the left details Fitch's rating methodology and outlook over the next 12 months, 5 years, and beyond that. There are two main stories to follow here. Firstly, we have a big trend of digital transformation. On this front, issuers have been meeting objectives around safety and operational resilience amid this work from home environment, and have increased a focus on supply chain recalibration. In addition, consumer behavior on the demand side has been shifting with a wider adoption of e-commerce and a rising online activity. Fitch is looking to changes in operational efficiency and regulation coming out of the tech developments. The pandemic has also stalled, however, not derailed progress with regard to a more environmentally friendly outlook on the world. This move to a low carbon economy has been partially stalled, and capex for US corporations could decline by an average of 10% in 2020. Part of that is dedicated to improving the environmental characteristics. It's likely to then grow around single digits through 2022, and significant cuts in the capex heavy energy sector are going to improve FCF and help preserve cash. This is really necessary and is oftentimes imperative to allow these companies to continue to be in compliance with their negative covenants. CapEx budgets in the healthcare and utility sectors are also mostly unchanged due to the essential nature of these products and services, which is a pretty interesting sectional divergence to watch. In addition, particularly in emerging markets, authorities are prioritizing a near-term economic recovery over long-term environmental objectives, such as a reduction in emission. So, two big stories to watch there, and it's interesting to see how they affect different industries and different sectors very differently. All right, some corporate updates to talk about. Firstly, let's talk about the summary. The high yield spread above US Treasuries has tightened to 460 basis points from 525 basis points the week prior. Carnival Corporation in particular saw its 7.2% senior unsecured notes due in 2023 decline about 5 points to 82 cents on the dollar. As of November 2nd, the company did announce the extension of its paused operations out of its North American ports until December 31st. This is coming off originally being set, or previously being set at December 1st, rather. No leverage loans were launched during this week because of the election this past Tuesday. Also, be remiss if I did not mention President Biden just did win the election and will start being the American president this January. The Senate is still up for grabs and is in question, and we'll see how the recount process occurs in Georgia and if that leads to any changes there. In addition, dividend yields have been consistently the largest driver of the four deals in the market that launched between October 8th and October 29th. Two high-yield bond deals were priced. However, one of these was withdrawn. Molina Healthcare was the only one to price with $650 million, pricing at 3 7/8 for their 2030 notes. And then also senior unsecured, we see $330 million of their 4 7/8 due in 2025 with that nearer term maturity. The franchise group wanted to get $650 million of debt raised in the market. However, that first lien was withdrawn amid heightened volatility given the election. This was intended to repay senior secured debt and help with debt repayments more broadly. All right, let's dive into corporate credit watches. Firstly, Cdro Partners. This is a company that announced on November 1st that it was no longer within its grace period for its missed $46.3 million interest payment that was due on September 30th. This was under its term loan A. They have strategic options with financial stakeholders that may include a comprehensive restructuring, which does equate to a likely equitization, doing a debt for equity exchange. So they do have about $2.6 billion of debt, and it is one of Fitch's top loans of concern. It's been on that list since August 2019. For more info, I suggest going on SEC Edgar and looking into its 6K filing. Pacific Drilling had filed for its Chapter 11 bankruptcy, and on October 30th, the company elected to skip 31.4 million in interest payments for its 8 3/8 first lien notes due in 2023, and also 20 million payment in kind interest payment for its 11/12 toggle second lien PIK notes due in 2024. The restructuring support agreement, the RSA, has garnered support from about 72% of first lien notes and 73% of its second lien payment in kind toggle notes. And the pre-petition debt for the company totals $1.1 billion. All right, moving on. Cbl and Associates. This is a REIT that just filed for Chapter 11. They entered into an RSA with stockholders, with debt holders rather, getting support from 62% of its 5 1/4 senior unsecured notes due in 2023. It's 4.6% senior unsecured notes due in 2024, and it's nearly 6% coupon senior unsecured notes due in 2026. They have 2.5 billion of pre-petition debt, and this is composed by 1.4 billion of senior unsecured notes that will be eliminated in exchange for 500 million of new 10% coupon first priority notes in 2023, as well as $50 million in cash payments and 90% of common equity. So that's the restructuring plan there. Moving on, another REIT to talk about, Pennsylvania Real Estate Investment Trust. They're the largest mall owner in Philadelphia. Given the environment for malls right now, this is not too surprising. They also did file for bankruptcy this past week. Calen Petroleum is another thing to talk about. This is an oil and gas explorer company, so E&P exploration and production. They announced on November 2nd that they had entered into a distressed debt exchange, a DDE agreement with note holders. This is their second attempt at exchanging these aforementioned notes. And on May 26th, the company announced the termination of its private DDE offer that it had tried to do before, where they had wanted to exchange the existing senior unsecured notes for about $300 million of the new 8% coupon second lien notes due in 2025. Also, two more stories to talk about. High Ridge Brands, their liquidation became effective on October 30th after receiving confirmation of its liquidation plan on October 8th after filing back in December 2019. This is a company that sells hair, skin, and oral care brands. And in total, the assets are around 120 million US dollars. The pre-petition debt included about 263 million outstanding under a first lien credit facility and 250 million more under under some sort of unsecured notes. Yeah, so these nearly 9% coupon senior unsecured notes due in 2025. So the lenders for the first lien estimated about a 35 to 36% recovery. And in the 2025 series, we see an estimated 4 to 5% recovery there. Also, last story to talk about, the retailer GNC Holdings. This was a big bankruptcy story. They officially emerged from bankruptcy on October 30th. We received confirmation of its reorganization plan on October 14th after filing for Chapter 11 back in June, the end of June. So pre-petition debt included about $60 million of outstanding on its ABL revolver. This is an asset-backed loan. And also 275 million in its FILO, first in, last out term loan facility, 410 million of its tranche B2 term loan, and 156 million of 1.5% 2020 convertible unsecured notes. The company sold substantially all of its assets, which means it is a Section 363 credit bid to Chinese company Harbin Pharmaceutical Group Holding Ltd. for about $770 million all inclusive, selling substantially. The secured B2 term loan recovered about 99%, and the holders of the deficiency claims, general unsecured claims, and convertible notes received a mere 3% recovery. It's just another reason to be very conscious of where you sit in the capital structure and how that will directly impact your recovery rates. All right, well, that's just about all I wanted to talk about today. I look forward to seeing you Monday for the next iteration of Market News Flow, number 24. In the meantime, have a great weekend, and thank you so much.